Hey everyone, welcome back to my channel Stock Predictor. Today, we're diving into a topic that's got a lot of dividend investors talking. SCHD, the Schwab US Dividend Equity ETF. Some people are saying it's broken, others are calling it the holy grail for dividend investors. So what's the truth? Is SCHD really the perfect dividend ETF, or is it hiding some risks that every investor needs to know? Stick around, because today we're breaking it all down. SCHD has been a favorite in the dividend investing community for a while. It's praised for its high dividend yield, strong track record, and focus on quality companies. But here's the thing. Nothing is perfect. Even an ETF as popular as SCHD has limitations, and ignoring them could cost you. Let's start with the basics. SCHD stands for Schwab US Dividend Equity ETF. It focuses on U.S. stocks with a strong history of paying dividends. The fund screens for companies with solid fundamentals, including consistent dividend payments, strong financial ratios, and overall quality metrics. The idea is simple. You're buying into a basket of companies that not only pay dividends but have the potential to grow those dividends over time. Now, that sounds great in theory. But here's where it gets interesting. When people say SCHD is broken, they usually mean one of three things. Its dividend yield isn't as high as it looks, it's concentrated in certain sectors, or it may underperform during certain market conditions. Let's break these down one by one. First, the dividend yield. SCHD often boasts a yield in the 3% range, which sounds pretty solid. For investors chasing income, that's attractive. But here's the catch. Dividend yield alone doesn't tell the full story. A high yield can sometimes be a warning sign that a stock's price has dropped significantly or that the company is struggling. In SCHD's case, the yield is generally sustainable because it's composed of companies with strong dividend histories. But investors need to understand that yield fluctuates with the market. During a downturn, SCHD's yield might increase simply because stock prices have dropped, not because the dividends are growing. That's a nuance that many investors overlook. Next, let's talk sector concentration. SCHD has a heavy weighting in technology, consumer staples, and healthcare. While these sectors are known for stability and consistent dividends, they also create concentration risk. If one of these sectors faces a downturn, think regulatory issues in tech or rising interest rates affecting consumer staples, SCHD could take a hit. This is where some critics say the ETF isn't as diversified as it appears. Sure, it has over 100 holdings, but the performance of the top holdings can dominate the fund's results. In other words, SCHD isn't broken in a technical sense, but investors need to understand that sector concentration can lead to volatility. Then there's market performance. SCHD performs well in bull markets, especially when dividend-paying companies are in favor. But during periods when growth stocks outperform dividend stocks, SCHD can lag. For instance, during a tech boom where growth companies reinvest profits instead of paying dividends, SCHD might underperform broader indexes like the S&P 500. This doesn't mean SCHD is a bad investment, it just means it's not a one-size-fits-all solution. Dividend-focused investors need to be aware of this cyclical nature. Another point that often gets overlooked is the effect of interest rates. Dividend ETFs, including SCHD, are sensitive to rising interest rates. When rates go up, bonds and other fixed income investments become more attractive compared to dividend-paying stocks. This can put pressure on dividend ETFs, causing their prices to dip even if the underlying companies are performing well. So if you're investing in SCHD purely for stability during inflationary periods, you need to be mindful of how interest rate changes can impact your returns. Now, let's talk about something that's rarely discussed: dividend sustainability. SCHD prides itself on selecting companies with strong dividend histories. But past performance isn't a guarantee of future performance. Even the most reliable companies can face unexpected challenges. A recession, supply chain disruptions, or regulatory changes can impact a company's ability to maintain its dividend. SCHD's screening process helps mitigate this risk, but it doesn't eliminate it. So as an investor, you need to monitor the broader market and be prepared for fluctuations. Let's get into some numbers. SCHD has delivered an impressive historical performance with annualized returns often outperforming many other dividend ETFs. But here's the twist. Most of this performance comes from capital appreciation, not just dividends. Many investors chase dividend ETFs solely for income, thinking they'll get guaranteed returns. The reality is that the total return includes both price growth and dividend payments. Ignoring the capital appreciation component can lead to unrealistic expectations. So, who is SCHD best for? If you're a long-term investor looking for steady income combined with moderate growth, SCHD can be a solid choice. It's particularly suitable for those who want a hands-off approach to dividend investing. The ETF does the heavy lifting by selecting high-quality dividend-paying companies. You don't have to pick individual stocks, which reduces the risk of owning a single underperforming company. But SCHD is not for everyone. If you're looking for ultra-high dividend yields or aggressive growth, this ETF might not meet your expectations. Its conservative approach means it's designed for stability and reliability, not speculative gains. And if you're someone who panics during market downturns, you need to remember that SCHD, like all equity investments, carries risk. Prices can fall, dividends can be cut, and past performance does not guarantee future returns. Now, let's talk about an overlooked advantage: SCHD's tax efficiency. Many dividend ETFs distribute qualified dividends, which are taxed at a lower rate than ordinary income. For investors in higher tax brackets, this can be a subtle but significant benefit. Additionally, because SCHD has a low turnover rate, it tends to generate fewer taxable events compared to actively managed funds. This is a detail that can save investors money over time, especially in taxable accounts. Here's another interesting point: SCHD's expense ratio. It's incredibly low, around 0.06%. That's one of the reasons it's so attractive. Low fees mean more of your money stays invested and compounds over time. If you compare SCHD to actively managed dividend funds, the difference in fees can be huge over a decade-long investment horizon. Keep this in mind: fees may seem small, but they add up. Now, let's address the elephant in the room. Some investors say SCHD is broken because it hasn't always shielded investors during market crashes. For example, during the early stages of the COVID-19 pandemic, SCHD dropped along with the broader market. Critics point to this as evidence that dividend ETFs are not as safe as they seem. But the reality is, no equity investment is immune to market downturns. Dividend ETFs like SCHD are designed for long-term stability, not short-term market timing. If you panic sell during a downturn, you're missing the point of dividend investing, which is consistent, long-term growth. Another nuance worth mentioning is the international exposure, or rather the lack of it. SCHD focuses exclusively on U.S. companies. While this is great for those bullish on the U.S. economy, it limits exposure to global markets. International dividend ETFs can offer diversification and exposure to companies growing outside the U.S., which SCHD doesn't provide. This isn't a flaw, per se, but it's something to consider if you're seeking broader diversification. Let's also talk about reinvesting dividends. One of the most powerful strategies for maximizing SCHD's potential is to reinvest your dividends. This allows your investments to compound over time. Even if the market fluctuates, reinvesting ensures that you're continually buying more shares of dividend-paying companies, which can significantly boost long-term returns. Many investors underestimate how much reinvestment can amplify growth, especially over decades. And finally, let's address the psychological side. Dividend investing is not just about numbers, it's about mindset. SCHD is built for investors who are patient, disciplined, and focused on long-term income. If you're constantly checking the stock price or trying to time the market, you might get frustrated. The real power of SCHD comes from consistency, sticking to a plan, reinvesting dividends, and letting compounding work its magic. So, what's the final verdict? Is SCHD broken? The short answer: no. SCHD is not broken, but it's not perfect either. It has risks, including sector concentration, interest rate sensitivity, and market volatility. Its yield is solid, but not extraordinary. Its performance is strong, but historically tied to U.S. dividend-paying companies. What makes it attractive is its quality screening, low fees, and long-term reliability. If you understand its strengths and limitations, SCHD can be a powerful tool in your dividend investing strategy. For dividend investors, the key takeaway is this: never rely solely on yield or past performance. Look at total returns, understand sector exposure, monitor interest rate trends, and focus on long-term consistency. SCHD is a solid choice for disciplined investors who want exposure to high-quality, dividend-paying U.S. companies, but it's not a magic bullet. Knowledge, patience, and strategy are what really make dividend investing work. If you're considering SCHD for your portfolio, think about your goals. Are you looking for income, growth, or a mix of both? Are you prepared to weather market fluctuations? Do you understand the sectors and companies behind the ETF? Answering these questions will help you decide if SCHD fits your strategy or if you need to look at other dividend ETFs or a diversified mix of investments. In conclusion, SCHD is not broken, it's just an ETF that, like any investment, comes with pros and cons. It's designed for steady, long-term income with moderate growth, low fees, and quality companies. It's not designed for ultra-high yield seekers, aggressive growth hunters, or short-term traders. Understanding this distinction is crucial to avoiding disappointment and making informed investment decisions. So, if you're a long-term investor willing to ride the ups and downs of the market while collecting dividends, SCHD could be an excellent addition to your portfolio. But always remember, no ETF or stock is flawless. The key to success is diversification, consistency, and staying informed. Alright, that's it for today's deep dive into SCHD. I hope this helped clarify whether this popular dividend ETF is really broken or just misunderstood. If you found this video helpful, don't forget to hit that like button, subscribe to Stock Prediction, and turn on notifications so you never miss our market insights. Drop a comment below if you're invested in SCHD or thinking about it. I'd love to hear your thoughts. Thanks for watching, and remember, smart investing isn't about chasing hype. It's about understanding the facts and making informed decisions. I'll see you in the next video.